Las Vegas. Welcome back to our Vegas Realty Check, your local Las Vegas real estate news show. I'm Trish Williams.
And I'm Tiana Carroll.
Sorry, jumbled start there this morning. So today we're going to be having a show. We're going to be talking about thinking like a bank. So we have a great guest, and we're excited about the show today. We're going to be bringing someone in remotely, which is different for us. Why we have headphones if you're watching us here on the show. So it's a little bit different, but we are excited to talk about all of these great things and financial asset protection. Before we get started with that, let's talk about inventory.
Okay, before we bring on our guest, we are going to talk about inventory. So I was a little shocked when I saw the inventory this morning. I know that this past week has been crazy busy, and last week we had a jump in inventory, but we had that same decline in inventory again. So our single family residents on the market in Vegas, again, Las Vegas Valley, taking out Pahrump and Boulder City and stuff, dropped down to 3,783 homes for sale.
Yes. Last week I was right in the same mindset of you, of wondering if inventory was going to start increasing again because our number jumped up a little bit.
Like almost 1,000.
Yeah.
It was crazy.
All that is really, I think that sellers are getting the idea now that there's buyers out there, so they're ready to put their homes back on the market again.
Yeah.
So we've seen that little bit of spike, but because buyers are out there, they're buying them. So
they are buying them. How many homes did we sell this week?
This week we sold 604.
Yeah.
So the sold numbers are still staying pretty healthy, and we're seeing minimal price reductions. So that's
we had like 80 price reductions.
80 price reductions.
And when I went through and I looked at the numbers, most of those price reductions were all under 3% price reduction. There was a couple. My favorite, the highest one of the week was they did a price decrease of 7.77%. And I was like, oh, they're feeling lucky. But for the most part, those price reductions are minimal. A lot of them just trying to get a little attention on their house and see if they can stir some activity.
Right. And I've been out there, boots on the ground out there in the market, and there's people out there wanting to buy, wanting to see what's available. Buyers are motivated again. So we're just seeing healthy amount of activity. Nothing crazy, but healthy. So that's good.
Yeah. And, well, I think in this time, especially when we're getting clickbait and the news is spinning that markets are crashing, that it's good just to be healthy. And that is exactly what our market's doing. We have steady growth.
Yeah. So real estate is still not crashing, people.
Still not.
It's still not. That's those are really big conversations that we've been having for the last couple months. Is buyers wanting to know if the market's declining, and our numbers aren't showing it. So that's
which makes us a very healthy spot to invest in, which kind of leads into our guest today.
Yes.
So, do you have any news that you want to go over before we bring on our guest?
There is nothing breaking or major. It seems like the news outlets are regurgitating the same thing they have been over the last couple of months. So.
Yeah. And I did see like the FHA is now doing a 40-year term, and everybody is assuming that that is for the purchase. But when I dove into it a bit, that's actually for people who are needing to make adjustments in their current mortgage. That's FHA.
Right. So going for a 40-year mortgage. And that's also, on that note, a good thing, because I've gotten a lot of questions about this over the last couple of weeks, is this 1% that's circulating. There's a 1% down program circulating. Now that is below median income,
right?
So for the program, and it's it's just not a traditional program that's going to be available to everybody. We can definitely provide you details if you're interested, but it's not like your traditional mortgage program option.
Right.
So
well, that's the thing. There's always different products out there. So if you'd like to have a conversation about real estate and how it can be used to benefit you, whether it's an investment or a first-time home, if you're going to use a down payment assistance, then definitely contact either Trish or myself and make sure you have those conversations, because where there's a will, there's a way. And if getting into real estate is something you're interested in, we can definitely make that happen for you.
Absolutely. And our guest today has some financing options as well. So we have some things to talk about. So
yeah, I never thought
him.
I'd be very, very excited about insurance and all of these different things. But we have found this amazing guy. His name is Sarry Ibrahim. Sorry, Sarry, if you can hear me, Sarry Ibrahim. And he is the founder of the Financial Asset Protection. And what's really interesting about him is he's using this infinite banking concept. It's also known as banking on yourself. And it is just, I felt like it was gatekept my entire life until I came across it. I had no idea that this was even something that was available to people. So I'm very excited to bring him on. Sarry, can you hear us?
I can hear you. Yeah, thank you so much for having me on. It's a pleasure to speak to you and be on your podcast today, or your show today.
Ah, great.
Thank you. And Sarry, you are a podcast host as well for a podcast called Thinking Like a Bank, right? Okay,
yes, correct.
If you're listening, watching this show, go check out his podcast because I'm sure he's going to have a lot more information on all the great things that we're talking about today. So
and in more detail than we're going to be able to cover in this show.
Yeah,
today.
Absolutely. So make sure to go check out his podcast, download it, subscribe to it, and you can get all of the goods there. So yeah.
So before we get started, Sarry, tell us a little bit about yourself because you're our first remote call in. So you're in Chicago. Okay.
Yeah, I'm in Chicago, from Chicago. I'm born and raised here, and I started the company Financial Asset Protection about 8 years ago when I was doing my MBA. And really what we are is we're a financial services firm. We help clients in all 50 states build wealth, plan for retirement. If they're looking to sell their business, what to do financially there. If they're looking to transition from their full-time job to start their business. We want it to be kind of like a full-service financial services / like financial coaching firm. And then we also, as you mentioned, specialize in the infinite banking concept, which is really common amongst real estate investors. Like if you check out real estate podcasts, you probably came across the infinite banking concept. So that's exactly what we do, and that's what I wanted to share with you on the show today, as well as other financial strategies you want to talk about.
Yeah, we appreciate that. Thank you. So for our listeners out there who are just hearing about this bank on yourself concept, will you tell us a little bit about that, sort of the quick fix for people?
Yeah, definitely. So it was introduced in the book Becoming Your Own Banker by Nelson Nash about 30 years ago. And what it is, it's a way for you to become your own source of financing. And the way it works is a little bit counterintuitive. Like a lot of people have never heard of this. And I don't blame them because it would be really difficult to come across this concept just naturally. So what it is, it's a way for you to use life insurance. And a lot of people are kind of like confused once I say life insurance. They think like we were talking about real estate, we were talking about investing. What does life insurance have to do with this?
Right.
In general, there are two types of life insurance. There's term life insurance, which is just like a life insurance only, which is more common. A lot of people have this through work. It's like a 10-year, 20-year, 30-year term policy. It's life insurance only. And then the opposite of that would be cash value life insurance. So this is life insurance, and there's also cash value in it. And there's many different kinds of cash value life insurance, but in general, we're talking about whole life insurance. So it's a way for you to build cash in a life insurance policy, and then you use that cash for other things. And then the cash obviously grows over time. So you get the guaranteed growth in the cash, as well as the ability to borrow against it and use for other investments like real estate, like your business, or anywhere else for that matter.
Okay, so I guess I have a misconception, if you can clarify for me, because if I'm listening to like Dave Ramsey or Susie Orman or whatever, they're saying whole life insurance, you can't pull cash out of it. There's only like a 1.5% interest gain on it, and you can't touch money for 20 years. So what am I missing here?
Exactly. Yeah. So there are many different. So there's about 2,000 life insurance companies in the U.S. And of those 2,000 companies, there's many different ways to structure life insurance policies. So it all depends on the company you're using and then the way you structure the policy. There are ways where you could structure a life insurance policy for it to be liquid within 30 days, and for it to break even in like 4 years, meaning that the premiums you put in and the cash value that's built up meet each other. So the cash value equals the premiums within 4 years. And then there's a way where you can get like close to a 4 or 5% internal rate of return in the policy over like a 20 or 30 year period, which is not bad compared to like savings accounts. So it all depends on how you structure the policy and how the agent's knowledge of how the policies work. That's really important. Now, Dave Ramsey and Susie Orman could be right that a whole life policy could take like 20 years to build up cash value, that the rate of return could be like 1%. That is possible if you structure it that way. So like if you structure a whole life policy only for life insurance only, like that's the only intention of it, then yeah, like you won't be able to access cash value for like 20 years. It'll be really slow cash value. But the way we structure the policies are for investment purposes. So like they are intended on high liquidity, high early cash value. I just think that Dave Ramsey, Susie Orman they don't really know how the policies work. They haven't came across these policies. And I think a lot of people, like if you go to Google right now and search whole life insurance, that's the information you're going to come across. You know, you have to do 20 years, it's a 1% rate of return. And that's simply not true. There are other ways around it to build up policies to accelerate the cash value growth.
Okay.
So I have a question on that. So if somebody already has a whole life insurance policy, so for this program to work, it's not going to be, they're not going to be able to use the policy that they have with another company. They have to start a new whole life insurance policy. Am I understanding that right?
It depends. If they already have a current whole life policy with one of the companies we work with, then we could probably readjust to certain things in the policy. But let's just say it's not. Let's just say it's a completely different company. Then we could do something called a 1035 exchange, like in real estate, how there's a 1031 exchange.
Right.
In whole life insurance, there's a 1035 exchange where you roll cash value from one life insurance policy into another tax-free. So we could potentially do that. So assuming somebody who's listening to this, they have a whole life policy, they have cash value in it, but they want to use this bank on yourself concept, they could potentially roll the money from their current whole life policy to a new whole life policy that will do more of the cash value functions.
Okay. Very nice. Very nice. So let's do a little exercise for our audience. Let's say I have $100,000 sitting in my bank account, and I go, Sarry, you're known for making money for other people. Let's make money for me. How are we going to go about doing that?
Yeah, good question. So if you have $100,000 in your bank account, you're looking for an alternative to it, like you're looking for somewhere else to store this money. We could do something called a single premium whole life policy. That's where you just take like the $100,000, you put into a life policy as a one-time payment. So that means it's a single premium. It doesn't require any more premiums after that. And then as soon as you do that, you have about $85,000 that's liquid that you could borrow against, that you could use for like other purposes. Let's just say real estate in this case. So in this situation, this works really good for like super high early liquidity. You could access $85,000 within 30 days, and you still have life insurance. Now, it depends on a lot of factors, but just based off of limited information, your life insurance would probably be like $400,000 if you put $100,000 in, and then you could leverage that. You could leverage your life insurance policy to buy real estate now. And let's just say you use $85,000. You bought a rental property. Just to use like a simple math, like your net income from there is like $1,000 a month. Now you have your rental property generating income for you, and then you have your life policy that still grows because that $85,000 you used didn't subtract from the principal. You just leveraged it. You borrowed against it, and now you have money growing into different places. You have money growing in your whole life policy, and then you also have your rental appreciation, and then you could use the rental income even to pay back towards the policy to increase the cash value for the future.
Okay, so that was going to be my next question. Once you pull the money out of that high value cash whole term life insurance, then when is that payment due?
Yeah, so it's a very flexible non-recourse loan. So that means that when you take out this money, the only collateral you need is just the life insurance policy, and it's like a private personal loan between you and the insurance company. So there's no payback structure. The insurance company will never send you a bill saying like you have to pay this amount back. The way it works is that whatever amount you take out, you would simply take that amount, and then as of today's interest rate, that's 5% simple interest. So you would take, for example, just to use even numbers, like $100,000 loan, 5% simple interest would be $5,000 annually, and then you take $5,000 and you divide that by 365 days, meaning that your loan will grow by that amount. Let's just say, I don't know, $14. It would grow by like $14 every single day for that outstanding loan. And then you have as long as possible to pay it back. You can actually not pay back at all if you want to. You would just let the policy loan interest build up, and then like let's just say you pass away at the age of 100, the insurance company will take your life insurance and then subtract any loans and interest due, and then pay that to your beneficiaries. So it's a very efficient way of borrowing because there's no like pressure to pay that money back within a short period of time.
I love everything about this. I mean, leveraging your money to make money is something that we talk about in the show, especially in real estate. And I like being able to think like a bank concept where you get to take this life insurance policy. It's still gaining its appreciation. Is that what you call it in the
Exactly, yes.
insurance world? But you're also able to take that money, leverage it into other investments. And it doesn't have to be for real estate. I wish it would be for real estate, but it could be for anything, right? You could buy a car, you could take a vacation, you could remodel your house, right?
Exactly, yeah, precisely, yep. And then it can even get to the point where you have enough cash value, like over time in the policy, where you don't even need to go to a bank anymore. So imagine you're in the market looking for a property. Over the years, you've built up, let's just say, like $400,000 in cash value. You find a property you really like. You could skip the bank in that sense. You don't have to worry about 2 years of W-2s and 1099s and credit checks, credit score, and debt to income ratio. You can skip all of that and just go straight to your insurance policy. It's a one-page form. You put your policy number, you put how much cash you want, and then within 3 to 5 business days, it's directly deposited into your account. So this is a super liquid way for you to skip banks. Of course, I know not everyone's going to be able to just magically have $400,000 in a life insurance policy. It's going to take time to build that up. But once you do get there, it could work much more efficiently than going through bank financing.
So this is basically a sort of a savings account, in a sense. Whether it's saving towards your life insurance or saving towards anything, it's essentially a savings account. What type of fees are involved in this?
Yeah, definitely. It's a good question. So when you start the policy, so for instance, for example, when I mentioned the $100,000 example, so when you start that policy, your cash value in year one is going to be like $85,000, for instance. Now that's also like your cash surrender value. So that means if year one you put $100,000 in and you said, you know what, I want to cancel this. Just give me all my money back. I want to cancel this. The insurance company would probably send you roughly around $85,000. That would be the fee in year one. So roughly, it's not a fixed number, but in this example, that would be the difference between your premiums in year one and then your cash surrender value is the cost of insurance. Mm-hmm. Now the good thing about this is that the cash value grows over time. So about 3 or 4 years later, now you're at a break-even point, and then your policy keeps growing at that point. So there is a fee when you start the policy, or not necessarily a fee, but more so a cost of insurance. But then you end up recouping that cost of insurance through the growth of the policy in the later years. So it's a long-term strategy. It's something you want to have a long-term vision for. You don't want to do this just for 1 year. If you do so, you'll most likely lose money if it's just like a 1-year thing that you do. You want to space it out for like a 10 or 20-year period, so that way you can actually see gains in the policy and then see gains in the other things you do, like in the other investments that you do.
Right. Okay. And then also so if you're taking money out of this policy and using it as, say, for a mortgage, you take $100,000 out, since that's the number that we've been using. Is this $100,000 that you're taking from the policy going to show as some type of lien or something against the property that you're buying, because that's where you took the money from?
This is actually my favorite part about the concept, because no, it does not. You can even tell the bank, like if the bank's going to, for example, your $100,000 is a 20% down payment. The
Mm-hmm.
bank's going to ask you, where did you get this money from? You could tell them I borrowed against my whole life insurance policy. And the bank will approve. They'll take that as if you took that out of your checking account, your money, because
Mm-hmm.
they know that, number one, the whole life policy, they know you don't have to pay that loan back, and they know that it's a non-recourse loan. So that means that in the event that you don't pay the life insurance company back, the only collateral they have is just the life insurance policy itself. Whereas if you told the bank that you borrowed from, for example, from someone else for that down payment, they're not going to approve that. Most likely they won't approve that because the bank doesn't want to share the collateral with another lender. They want to be the only lien or the only lender in that situation. But when it's a
Right.
life insurance company, there are no liens outside of the life insurance policy itself. The
And no-
limit,
Well, no payment responsibility, because one of the things the banks looks at, it's not only the fact that there's a lien from the other money that you borrowed, but it's the payment responsibility. They have to take that into your debt to income ratio of the amount of money that you owe back. So because you're technically borrowing this, does there have to be a stated payment? I would assume the if it's being showed as borrowing or some type of loan, that the mortgage company that you're dealing with is going to want to see what type of repayment you have structured for this,
Yeah.
or is that a question not asked?
It's not asked, yeah, because they know that you don't have to pay that loan back. So like the repayment structure is not a consideration.
Okay.
All right. And what about restrictions, like in an IRA? What do these whole life term policies have in restrictions? Like if we're going to look at the cons, because all of it sounds beautiful, right?
Mm-hmm.
Rainbows and butterflies. Like you get this life insurance policy, you can have your money working in 2 places. What are the downfalls?
Yeah, exactly. Good question. So you can access the money at any point. You don't have to wait until you're 59 and a half to access the money like you would an IRA. You could use the money either for active, or you can use the money for anything you want, including active and passive investments. Now, what I mean by that is, like when you have an IRA, for example, and you want to use your IRA to invest in real estate, you would have to do so through a custodian. Like you have to roll that money into a self-directed IRA, and then in
Right.
the self-directed IRA, in real estate investments, you do have to be entirely passive. Like it has to be a property management company that handles everything, or like a real estate syndication that handles everything. You can't be involved in any activity with that. With a life insurance policy, it doesn't matter. You could use it for passive real estate deals, or you could really buy real estate on your own, deal with the contractors, be actively engaged in the real estate. It doesn't matter. So really, there are no restrictions. I won't be completely like biased and just say there's nothing wrong with whole life insurance at all, because the only thing is that it is a long-term strategy. It does take time. It's not something that's like instantly to change your life like overnight. There's a capitalization period. There's a build-up period. So like in this example, 100,000 would yield you or provide you with a loan up to 85,000. Now let's just say 100,000 was all the money you had and you needed every penny of it. Then the strategy is probably not going to be a good fit for you. So it's a long-term saving strategy in which like you have to think long-term, either put away a lump sum or put away monthly premiums for a longer period of time, so that it actually builds up, so that it's actually advantageous.
Another question I have for you, since you brought up like the IRAs and things like that.
Mm-hmm.
So a lot of people that are W-2 employees that are working for companies where the company will have a contribution to such things as IRAs, 401ks, different types of investment things there, and they use it as more of a tax benefit. Some of these items are deferred. There's benefits in the tax realm for doing that, and there's employer contributions in a lot of cases and employer accounts that are set up. Is this something that can be set up through the employer?
Absolutely, yes. It could be an employee benefit. Like the employer could do a couple different things. The employer could own a company policy, so the company owns the policy. It's a business asset, and then they could insure employees, and then they could, for instance, pay the premiums for the insurance policy where the company is the beneficiary, and then they could even have an agreement with the employee where it's like, if you stay with us for 10 or 15 or 20 years, then we'll turn this policy over to you. Like we'll change the ownership of this from the company to you. So they'll like gift, in a sense, like gift the policy to you. It could be used that way, or it could be used where the employee owns the policy. The employee's, for example, spouse or someone else's employee's life is the beneficiary, and then the employer will pay the premiums. The employer can get a W-2 deduction, so as if like they're increasing their W-2 income, and then the employee now can get this policy. They'll have to pay the W-2 taxes on it, and then they can own the policy. So you could do it where it's like an employer benefit. The difference though is, like, for example, with a 401k, that's like it's a pre-tax vehicle. So what that means is, as the money is going into the 401k, the employee is getting a payroll deduction for that amount going into it, and then when they take the money out, there's taxes owed. With this, it's the opposite. With whole life insurance, it's usually the opposite. The money going into it is taxed already.
Okay.
There's no payroll deduction, and then after it's inside the policy, then it grows tax-free. The loans are tax-free. The withdrawals are tax-free. The death benefit is tax-free. It's all tax-free at that point.
Tax-free, those are some of my favorite words.
Yeah, mine too. All right, is there, I don't know how to really put this in words, I guess, is there insurance on the insurance? So how is this policy backed? Like what are the securities behind it that guarantee that basically when people invest into this policy that they're not going to have some sort of losses, company's going to disappear tomorrow or something like that? Is there any type of insurance that protects this policy?
Yeah, good question, and that's it's an important point you make that, because what's the point of all these guarantees if the person backing it isn't, can't guarantee anything? So that's a good point. So these insurance companies have been in business for over 100 years. Like one of the insurance companies we use is owned by Western and Southern Financial Group, so it's a very strong financial company. They even own like banks, they own real estate investment companies, very strong financials that are made public, of course, and a very high degree of certainty that they're going to keep paying out dividends. So that's part of this concept, is that within your policy, you earn dividends every year based off of the performance of the insurance company, which is a big way of how you grow the cash value in the policy. And these dividends are based off of the performance of the insurance company. So there's a very high degree of certainty that these insurance companies are going to pay out dividends based off of their performance and also based off of state regulations. So insurance companies are typically regulated at the state level, and every life insurance company, every insurance company in general has to file annual and quarterly reports with the state, and they have to have a certain amount of reserves in place at all times, so that way they can meet the claims of their insured. So that way, let's say that if everyone dies or everyone gets into a car accident or everyone goes to the hospital, can the insurance companies pay out these claims? And they have to be able to prove that quarterly and annually through their reserves. They have to share that information with the state. So it works a little bit backwards from how banks operate. Banks are kind of operating in the sense of, we'll borrow money from point A and then we'll loan it out at point B, and we'll hope that both sides work out in our favor. Whereas insurance companies have to have the money in place first before they can invest it, before they could loan it out to other people. They have to have that money in their actual reserves that they actually own. So that translates into safe money, very safe money for the clients.
Okay, so you are held accountable by state regulations and everything there too. So,
of course, yes.
Yeah. Okay.
Excellent. Hey, I want to circle back around because we talked about W-2 employees, but in real estate and in Vegas, we have a lot of independent contractors, entertainers, things like that, who are self-employed entrepreneurs. How could we utilize something here on those, like, what is it, 1099s?
1099. Mm-hmm.
Yeah, absolutely. Good question, because you're right. A lot of like self-employed individuals, including realtors, they don't have like 401ks and pension plans. They have to kind of create their own retirement accounts. Of course, real estate rentals being a good source of that, like buying rentals. And then also another thing too is this strategy could definitely be used in the sense of like a pension. It's not a pension, of course, but it could be used like a pension, where every month you're putting money away from your 1099 income, you're putting money into this, and then it's growing over time. Typically, you want to use after-tax dollars to fund this strategy, so that way the money that goes into it is tax-free in the future. The loans are tax-free, all of it kind of tax-free in the future. And then absolutely, you could use it where every month you're allocating a certain percentage of your sales or your income into it, and then you do so for like 20 or 30 years, depending on how long you're working for. And then after that, you can even like use it as an income. So after funding it for a certain amount of time, you could even like turn on income and say, all right, you know what, now I've been putting in $1,000 a month. Now it's time to take out like $3,000 a month. Over time, you could take out like $3,000 a month, tax-free. And then you could use so obviously in connection or integration with other sources of retirement income, like Social Security, rental properties. You might have like an IRA somewhere else. So that's kind of the strategy we help clients with, is to have not just one whole entire like strategy for their income, but to have like 5 or 6 different sources of retirement income. Because if you think about it, like how would you keep working, like as a realtor, like, you're 7 years old, you're probably not going to keep working as a realtor or any job for that matter. So you need to figure out a way to keep getting income in without working for it. And this is what you do like during your working years, of course.
Okay. And what also, like, say you had the funds there for 20 years, just to give numbers. Yeah. What's the average rate of return?
Yeah. So I recently did the calculation on a couple of my policies. And over a 30-year period, it was around 4% IRR, so 4% internal rate of return.
That's nice.
You could expect that. Again, it's the actual rate of return in the policy it's a conservative rate of return. It's nothing too crazy. And I always tell clients, like, this is not the only benefit of it, right? The rate of return of it, because obviously like 4% is not gonna save you in any economic situation. You want to also look at it from the standpoint of it's just the availability of principal or the preservation of wealth in any situation. That I think is a more important factor. And then of course, it's not an either or situation where it's like I earn 4% in my life policy, or I go out and do real estate and I can earn 25 to 30% year after year as my rate of return. It's a way to do both. So that way you have your life policy that can fund real estate or other investments, and then those investments can then fund more life policies, and then life policies can reinvest into more companies or rental properties or whatever the case might be. So it's kind of like compounding with each other. That I think would be more advantageous, especially like as we're in this super uncertain economic time right now, as we're like in the mid 2023. If you haven't been watching the news, a lot of people are saying like right now is not a good time for the economy.
Right.
Right. I understand that. Now, also on top of that, I know where our time we went through here so quickly. One more question that I had on that: is there an annual fee that's charged to it? Monthly recurring fee? What are people expecting as far as fees for holding the policy?
Yeah, so there's no fees beyond the premium. So like, let's just say, for instance, somebody's gonna do a policy that's like, just use even numbers, like $10,000 a year for 20 years. That's it. It's just $10,000 a year for 20 years. They'll have the ability to add more money in, and then when they add more money in, that can increase the cash value and increase life insurance. But there's no like maintenance fee or like recurring annual fee or monthly fee in addition to the premium. It's just the premiums. All the fees and the cost of insurance are already baked into the premiums.
Okay, great.
Makes sense.
Yeah,
All
a
right.
lot of great information, Sarry. Thank you so much. If people wanted to get a hold of you and have an in-depth conversation about their specific situation and what would benefit them, how would they get a hold of you?
Yeah, well, thank you for having me on. And if they want to find me, it's thinkinglikeabank.com. So the website is thinkinglikeabank.com.
Okay.
And you can find everything there. You can find the podcast, YouTube channel, LinkedIn. You can email me, schedule an appointment. All that can be found at thinkinglikeabank.com.
Yeah, and we'll have that in the description for our YouTube channel. This, some people are listening to us on the podcast platforms, Spotify and Apple, but we also have a YouTube channel, Vegas Realty Check, that this will be on, and all of your information will be in the descriptions there as well.
Yep. Thank you so much for being on the show. And if you're watching our show, please like, comment, subscribe, share with your friends, tell people about the show, and check out the podcast, Thinking Like a Bank, as well.
Yeah.
And thank you guys
very
for
much,
joining
Sarry.
us. Yeah. Thank you, Sarry, for being on the show. And we will see you guys next week again, right here on Vegas Realty Check.
But wait, we didn't give our contact information. Trish. How would they get a hold of you if they wanted to take this insurance policy and turn it into an investment here in Vegas?
Absolutely. So my phone number is 702-308-2878. You can text me, call me. You can email me at trish@trishwilliams.vegas.
All right. And I'm Tiana Carroll. If you want to have a conversation with me, I'm at 702-379-9948.
All right.
All right.
Thank you, guys. Thanks for joining us, and we'll see you next week.
Bye, you guys. Have a great week.